It's that time again. The Federal Reserve is preparing to make its first announcement of 2025. And of course, we are here for it to see if it is going to do anything to the markets on this very choppy, very volatile week we've had so far. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And we're going to unpack what there is to look at from this Fed policy announcement that we are going to get coming at us here in the next 24 hours and see what might be the vectors for market action here that are going to be in play as the Fed makes what looks to be like a maintenance business as usual kind of an update on the policy front. So if we take a look at what the markets are pricing in here, they are configured in precisely that way. So this is the probability that we're going to get no change in the target range for the Fed's policy rate. You can see here the current rate is set to a range of 425 to 450 basis points, or 4.25 to 4.5%. And the markets put the probability that we are going to stay there at this month's meeting at a commanding 99.5%. In other words, the markets are not at all expecting that what we are going to have here is any kind of change. Now, on top of that very strong level of conviction, this is also not one of those meetings where the Fed is going to update its summary of economic projections, give us some new guidance, at least in numerical format, on where it thinks the economy is headed and where it thinks the policy rates will need to go to respond accordingly. What we still have here, if we look at the market's own prognostications, is a pathway to 48 basis points in cuts this year. That's pretty much in line with the Fed's own forecasting the last time they updated it in December. The view for next year, looking a little bit light, only 22 basis points there for a cumulative 70 basis points this year and next. And if we look at the timing, the arrival of the next rate cut seems to kind of be pointed at June or so. Now, of course, these numbers here represent benchmarking to the median of the range. So 4.38, that's essentially the middle of the range, give or take here, between, and of course, these are market rates, so they're not going to give you the perfect median with the markets going up and down each day. But what that's showing you is essentially sitting in between 4.25 and 4.20 and 4.5. And so if you look here at 4.38 as essentially the place that you landed on today, and you subtract from that 25 basis points, you end exactly at 4.13. And of course, that's what you have baked in here for June. So this is your first cut. And by the end of the year, you almost get to a second one. So to get to that, you would need to be at 3.88. And of course, you can see we're right there, November, December. So both of these rate cuts that the Fed was looking for are essentially in the market. So here's the Fed's forecast from where they last updated it. They're looking, as we see here, for 50 basis points this year, 50 basis points next. If anything, the market's current setting is a little bit more hawkish relative to those prognostications, but all of that hawkishness is really focused on 2026, which at this point may not be the more actionable part of this story. So needless to say, then the question becomes, why do we care? Why do we need to think about this? The Fed is overwhelmingly expected not to do anything. Moreover, the outlook as it is priced into markets, at least for this year, seems to be basically in alignment. 2 rate cuts here, 2 rate cuts here, and 2 rate cuts here. So everything there seems to be largely beyond the scope of near-term speculation. Moreover, if we look at the way that the inputs here are set up, put that in context with what the Fed has been telling us over recent weeks and months, it doesn't seem like they have the ammunition to really deviate rhetorically and give us a different sort of landscape for what to expect next, even with those bits of this announcement that we are going to get this time, the policy statement, as well as a press conference with Fed Chair Jerome Powell after the FOMC committee sits down. So we have a setup here where the Fed has been telling us for quite a while now, and of course made it very official in the December policy statement, that they are at this point in the fine-tuning stages of the post-COVID inflation fight and of dialing in sort of the right balance between the Fed's objective to seek maximum employment and their objective to do that in a context of price stability, which they define as getting back to 2% inflation in a medium-term sort of way. If we take that sort of rhetoric from Fed officials at face value, if they are in fact in the sort of fine-tuning phase and they keep saying that the risks to the two mandates are roughly in balance, that they still think that they are going to get into a conversation about inflation being on target within sort of reasonable parameters. You can see that on the forecasts here, where the Fed is seemingly saying we're going to get to our target inflation by 2027, then there's really not the ingredients to rock the boat. Markets obviously made quite a bit out of the latest set of CPI numbers, and that the core reading was a touch weaker than expected, 3.2% versus 3.3%. But nevertheless, inflation has been somewhat stalling here, not running away, not moving in an untoward fashion to the upside. In fact, we can see here that most of the rise right there in the headline number has been essentially rebasing of energy. So whereas energy was more of a negative influence on prices, with time that seems to have rebased back toward neutral. And so we can see that the reduction of this negative coefficient on the energy side of things is really how inflation has ticked up. The core reading hasn't matched. And of course, what we care about, what the Fed ostensibly cares the most about, is the core reading, because as we can see, most inflation lives in services excluding food and energy, which is, of course, very much approximated by what the core is doing. So as we look at these numbers, it sort of makes sense that the Fed is looking at this and saying, well, we're still on course. We don't have a lot of new progress. I mean, clearly the pace of progress has slowed over the course of 2023 and 2024, but the trajectory is still pointing toward slower inflation overall, and we might take longer to get where we need to go, but we're not going to throw the baby out with the bathwater, as it were, and say that everything has changed. We are still on track to cut, just slower. And the data recently here doesn't seem to tell us that we shouldn't. Moreover, though, there is an argument for something of a contemplative pause, not so much to signal that rate cuts aren't coming, but to do the slow walking that the Fed has promised. Because if we take a look here at what the frequency and the higher sort of sensitivity inflation numbers have been telling us, they've been going somewhat the wrong way. So at the headline here, we can see acceleration in the 3-month annualized rate. But even if we look at the core here, and in the yellow is the 3-month annualized rate in the core, we did snap a trend toward increase in December. And that was, of course, encouraging. So we dipped a little bit here on these yellow bars. But the 6-month trajectory on core is still, as we can see here, toward acceleration. And so the Fed doesn't exactly have the kind of kindling here, as it were, to really ramp up in a dovish direction. We're still in this space where it seems like things are not falling apart, and the Fed doesn't need to start thinking about maybe abandoning cuts or maybe changing course in a U-turn kind of way toward hiking. But the evidence does not seem to be there to say the inflation scare is contained and we can just proceed in as dovish a fashion as perhaps the markets would like. There is a bit of evidence of economic slowdown in the latest PMI numbers that might start to build the scaffolding for that kind of a consideration. We can see here last week, very surprising outcome on composite PMI here, an approximation of U.S. economic trends that's a little bit more timely than GDP. And of course, as ever, this is done in a logic where 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. Not that we have any contraction on this chart here. Since the beginning of last year, the U.S. economy has been growing. And indeed, since May, it has been growing at a very elevated rate. And moreover, that rate was accelerating in the fourth quarter to some very heady levels. This was, in fact, for December, a 33, if memory serves, month high on U.S. growth, going all the way back to 2022. So if we put that in this context, this drop-off in January is certainly eye-catching. This is the weakest that we've seen since April of 2024. So not great. And a little bit shocking, although it is only one piece of data. And surely, if nothing else, the Fed might be inspired to sit on its hands and continue to watch before they jump out the window on what this might mean, especially since we still, on the whole here, seem to be looking at a situation where U.S. economic data has started to firm relative to baseline expectations. And here you get the sense that at the very least, what the U.S. economy is not doing is it is not cooling. At the very start of the year here, we had the sense that maybe expectations had started to line up with reality, and you saw that on this index we sort of arrived at 0 on the benchmark index here, and that of course suggested that the models that analysts have for looking at U.S. economic data and the actual outcomes have basically come together in relative harmony. But since then, what we see is a little bit more acceleration into some more upside surprise risk from these outcomes. So if nothing else, what the Fed has here are ingredients to stay put. Of course, we'll see what that all looks like and what it means for the incoming pieces of economic data. U.S. GDP still on the menu for this week, with a slight downtick expected from 3.1 to 2.7% in the fourth quarter, and the PCE version of inflation expected here. Much similar outcomes to what we saw in CPI PPI, relatively steady core, and a little bit of an uptick on the headline as we get less of a downdraft from energy. And as ever, still arguing for a Fed that is at face value uneventful. But then the context has to come into the conversation. And of course, that context we can sort of summarize with this chart of the S&P 500 and the violent sell-off that we saw yesterday. Not only was it the worst day for the benchmark stock index in 7 weeks, but it also occurred at a very auspicious spot, right at the highs that were tagged in December, and prolonging of this kind of standstill here that has given stocks essentially a sideways range after this rally from the lows in August. In plain terms, we had a series of higher highs and higher lows. As of December, we have struggled to make any new highs, and we've gone into some sort of a sideways contemplation mode. So not only did we get a big sell-off at the start of this week, but it happened in a place where you wanted to see confirmation that last week's strength would carry through. And at this key moment of challenge, upside sentiment unraveled. And so with that in mind, we look at the Fed policy announcement and say, okay, well, perhaps they are not going to deliver anything new or shocking or game-changing. But what does the market want to see? And after a sell-off and a rout of this magnitude, one might surmise that what the markets want is some soothsaying. Now, of course, we already expect the Fed to be dovish. As we've just mentioned, the last thing they forecast for us for the year was a pair of cuts, and the markets are indeed positioned for those cuts. So we are likely to get a dovish Fed. It's just everything that they're likely to say here in that direction and sort of the more general trajectory of policy is not only already said, it's in the price. We can see it in these Fed funds futures levels readily. So the larger question is, with the market's nerves still raw after this episode at the start of the week here, do they want more healing salve than just business as usual? And if they don't judge the Fed to be adequately responsive, because no doubt we are going to get questions about this sell-off at the press conference following the meeting, and if the Fed says, you know what, we really are not going to try to tailor things to the ins and outs of the stock market on a given day, we're certainly not going to try to respond with policy to the kind of shock that we just saw vis-a-vis concerns around the AI arms race and what the unveiling of China's DeepSeek model means in that conversation, ostensibly the catalyst for yesterday's sell-off, tech-heavy and AI-oriented though it was. We are running the risk that the market might look at the Fed and say, well, clearly something is amiss, and the markets are not well positioned to absorb the news flow that's coming, hence the panicked sell-off. If we don't get some sort of assurances about the sweet, cheap money that's almost certainly right around the corner in an adequately convincing fashion, then perhaps risk aversion comes right back because the markets feel that they don't have the necessary support, the necessary safety net to navigate what comes next. That creates a level of liquidation. Moreover, there is the political concern. Now, the new Trump administration started off relatively friendly, but what we see over the past 2 weeks or so is the tone has started to change a little bit, and we've started to see a little bit more of the kind of goading of the Fed from President Trump that we saw during his first term, where he's come out and said he knows more about monetary policy than the Fed, and they really should consult him about what to do next. We also know that he is favoring of lower rates, something that the Fed is going to be reluctant to commit to, looking at all the variables that we've just surmised, at least beyond where we already know, and that what this might set up is some kind of a clash, because, of course, we've also heard from Fed Chair Jerome Powell in the immediate wake of the election at the November policy announcement on this subject, and he could not be any more terse, basically saying we do not have any scope here to rewrite the rules of how the Fed operates. No, the fiscal side will not meddle in monetary policy. No, we will not take that input. We're going to keep doing what it is that we're supposed to do based on our mandate. And so, to the extent that this becomes a conversation in the press conference and overlays with this idea that the markets would surely want more of a dovish bias because, first, their nerves are raw from Monday's sell-off, and second, they would, needless to say, prefer for there not to be a clash between the White House and the Fed. If the Fed is not dovish enough to avert both of those concerns, that may be enough, despite an immediate pivot in policy or anything of that nature, to get sentiment unhinged. And then if that gives us something of a meaningful break here on the S&P to extend lower, then we might be in a whole other world altogether moving forward. And that is Macro Money for today. As ever, we are here right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. On Tuesdays, I'm likewise on with Victor for The Price of Truth. That's coming up in just 30 minutes after we wrap up here. I'm back with Chris for Futures Power Hour on Fridays and then Mondays as well. On with Victor and Tom for First Call on Sundays as the markets in the futures universe come alive at the Asia Pacific Open. I'm likewise commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money's back tomorrow. Happy trading.